If the United States were to enter a major conflict with Iran, the impact wouldn't stay overseas for long. It could quickly spill into inflation, financial markets, government spending, and the everyday costs households feel at home. Right now, investors aren't waiting for official confirmation of anything. They're trying to assess risk and how far the consequences could spread. In recent days, military positioning has accelerated. Aircraft carriers, cargo flights, fighter jets, missile defense systems, all moving into place. Nothing definitive has been announced. But markets don't wait for certainty. They price in possibility. And the central question being asked is simple. How large could this escalate, and what would that mean financially? The first pressure point would likely be energy. Iran sits along the Strait of Hormuz, a passageway that handles roughly 20% of the world's oil supply. Even the perception of disruption there can send oil prices higher. And when energy prices rise, they don't stay isolated. Higher fuel costs ripple outward. Trucking becomes more expensive. Shipping rates climb. Airlines raise fares. Delivery services adjust pricing. Within weeks, those increases can show up in grocery bills, online purchases, and everyday goods. Utility costs may also shift depending on how broader energy markets respond. It's not just about what you pay at the pump. Energy costs are embedded in almost everything you buy. If those pressures begin lifting inflation, the second layer comes into play: interest rates. Bond markets react quickly to inflation risk. If investors believe price pressures are building, expectations for future rate policy can shift fast. That feeds directly into borrowing costs. Mortgage rates can move higher. Credit card rates may stay elevated. Auto loans become more expensive. Even small percentage changes can meaningfully affect monthly payments. And this shift often happens quietly. There may not be a dramatic headline announcing it. But when you apply for a loan or refinance, you feel the difference. The third layer is financial markets. Geopolitical tension tends to increase volatility. Energy and defense stocks may rise, while broader indexes can swing based on how investors interpret the risk. Those movements affect retirement accounts, 401ks, and long-term investment portfolios. Even if you're not actively trading, market swings influence confidence. And confidence shapes spending and investment behavior. When confidence weakens, economic momentum can slow. Then comes the fourth layer: government finances. A sustained regional conflict would require significant funding. The US is already running sizable deficits, and prolonged defense spending would likely increase borrowing needs further. That doesn't mean immediate tax hikes or benefit cuts. But it does add long-term pressure to the fiscal outlook, particularly if higher spending coincides with renewed inflation risk. These pressures don't appear overnight. They build gradually. When you step back, this isn't a single event with a single consequence. It's a chain reaction. Energy prices move first. Inflation concerns follow. Borrowing costs adjust. Markets react. Government spending expands. And eventually, those combined forces filter down into everyday financial life. So as this situation develops, the key question isn't only what happens overseas. It's this: if higher costs, increased volatility, and tighter financial conditions begin to take shape, are you financially prepared, or are you assuming the effects will remain contained?